Hey everyone, and welcome to World Finance Brief. This is where we cut through the noise and look at what the data is really telling us about the biggest stories in finance. So today we've got a fascinating clash of titans. We're looking at two completely different futures for your money. On one side, an expert is painting this picture of a new golden age for investors. But on the other, a stark warning that a massive crash isn't just a possibility, it's practically a mathematical certainty. So, who's right? I mean, are we looking at the opportunity of a lifetime, or are we all just standing on the edge of a financial cliff? Let's dig in and see what both sides are saying. All right, let's start with the bulls. The optimistic view. This perspective, which is championed by strategist Yogesh Kirajani, basically says that if you play your cards right, the next few years could be, well, incredibly profitable. The key here is all about strategy and thinking long-term. Okay, so what does that strategy actually look like? This is a great breakdown for, say, a 30-year-old investor. It's a really diversified portfolio designed to get you that growth, but also keep the risk in check. Let's take a closer look at that biggest slice, shall we? So the engine of this whole thing? Equities. 50% of the portfolio. The plan is to put a big chunk, 30%, into the US markets, mostly because they're so liquid, right? Easy to get in and out. Then, you've got another 10% going to India. You're betting on their demographics and stability. And the last 10%? That's for other up-and-coming markets. Think places like Poland or Vietnam that are really starting to benefit from what people are calling friendshoring. Now, this is a really moderate way to think about precious metals. That 15% in gold and silver, it's not there to make you rich. Think of it more like portfolio insurance. It's your safety net. If things get rocky geopolitically, this is what's supposed to hold its value. All right, and here's the really futuristic part. Another 15% is set aside for what are called thematic investments. We're talking about betting on the massive megatrends of tomorrow. You can actually do this through special ETFs that give you a piece of whole industries. Think space exploration, DNA sequencing, cybersecurity, even the blockchain technology behind crypto, not the coins themselves. And this quote really gets to the heart of the entire bull argument. The idea is simple. If your money is just sitting in a bank account as cash, it's losing value every single day thanks to inflation. So the biggest risk isn't necessarily a crash. It's the risk of missing out on all the growth because you were too scared to invest. Okay, so that's the optimistic case. Now let's flip the coin completely. The other side of this argument says we're all sleepwalking into disaster, ignoring clear warnings from history, and that every single major crash follows a very predictable four-step pattern. So what's the pattern? It goes like this. Stage 1, everyone's super optimistic and asset prices are just going through the roof. Stage 2, warning lights start flashing, but the so-called experts tell everyone, don't worry about it. Stage 3, some kind of trigger event happens. Maybe a big company goes bust and it suddenly exposes just how fragile everything is. And then, Stage 4, the whole thing comes crashing down in a wave of panic selling. So, the big question is, which stage are we in right now? And if you look back at history, it's just full of these stage 2 moments. It's kind of chilling. In 1929, right before the big one, a famous economist said stocks had reached a permanently high plateau. Whoops. In 2000, during the dot-com bubble, analysts were saying valuations don't matter anymore. And remember 2008? Officials were on TV saying the whole subprime mess was contained. Every single time, the experts were telling people not to worry right before the floor fell out. And that brings us to the core argument from the bears. They believe we are deep in stage 2 right now. In fact, some are pointing to 14, not 1 or 2, but 14 different warning signs, all flashing bright red. Let's look at some of the most alarming ones. Okay, first up is something called the Buffett indicator. It's pretty simple. It just compares the total value of the stock market to the size of the whole economy, the GDP. Historically, the average is about 100%. Right now, it's at 230%. Let that sink in. The stock market is valued at more than double the entire annual output of the US economy. That is the highest it has ever been, ever. Then there's this one, the Shiller-Cape ratio. It's another way of measuring if stocks are cheap or expensive. Just look at this chart. The long-term average is down there around 17. Right before the 2008 meltdown, it hit 27. And today, we're way up at 39. That's not just a little high, that's way higher than we were even at the peak of the last bubble. And how about this for a ticking time bomb? Commercial real estate. You've got a staggering $1.5 trillion in loans that have to be refinanced by 2027. But here's the kicker. The buildings those loans are based on, their values have plummeted, down 40 to 60%. That could mean a massive wave of defaults, and the regional banks are the ones holding the bag. And the list just keeps going. Corporate debt, record high. People falling behind on their credit card payments, spiking. There's something called the SOM rule. It's been a perfect predictor of every single recession for the last 50 years. And guess what? It's been triggered. Oh, and the leading economic indicators, they've been pointing down for more than 20 months in a row. So, what are we supposed to make of all this? You've got these two totally competing visions of the future. Let's put them head to head. On one side, it's all about strategic growth. On the other, it's a warning of a correction of historic proportions. Let's boil it all down. In one corner, the bulls are saying, play it smart, diversify, think long term, and don't forget that sitting on the sidelines costs you money. But in the other corner, the bears are shouting, valuations have never been this crazy, the debt is out of control, and history teaches us one thing: what goes up must come down to the average. Okay, so with both sides of the story laid out, we get to the part that really matters. What does all this mean for you, for your money, for your future? Really, it all boils down to one massive question. Do you buy the argument that this time is different? That new tech and a changing world justify these sky-high prices? Or do you believe that history always repeats itself, and that a painful correction is simply a matter of when, not if? So where do you stand? Are you bullish, positioning for more growth? Or are you bearish, getting ready for a storm? We really want to hear your take on this. Drop your opinion in the comments below. Let's get this debate going. Make sure you subscribe so you don't miss our next deep dive into the world of finance. Thanks so much for watching.